For millions of Americans with federal student loans, the last few years brought a rare and unexpected financial reprieve. Suddenly, a major monthly expense simply disappeared, offering a sense of relief and breathing room that many hadn't felt in years. In March 2020, so Bartwerkuren Dashpin, Bein Barber Derb, as a deses of Ransdown. The COVID-19 pandemic swept across the country, the government took unprecedented action, student loan payments were paused, and interest rates were set to zero. This was a direct response to the economic uncertainty and job losses caused by the crisis, and it was a lifeline for borrowers facing sudden financial hardship. This relief meant no monthly bills to worry about, no growing balances from accumulating interest, and no threat of collections, even for those who had already fallen behind or were in default. For many, it was the first time in years they could open their mail without anxiety. With student loan payments on hold, families could redirect their money to essentials like groceries, rent, or medical bills. Some even managed to build up emergency savings, pay down other debts, or simply catch their breath financially for the first time in a long while. The payment pause, which was originally meant to be temporary, ended up being extended multiple times over the years. For many borrowers, this new normal became a source of stability in an otherwise unpredictable world. Collection activities like wage garnishment, tax refund seizures, and harassing phone calls were also halted. This offered peace of mind to those who had fallen behind, knowing that their paychecks and tax refunds were safe, at least for a while. But as the calendar turns to December 24, 2025, that era of relief is coming to an end. The pause that once felt indefinite is now officially over, and the reality of student loan debt is returning for millions. Payments have resumed, and the government is preparing to restart collections on defaulted loans. Borrowers are once again seeing payment due notifications, reminder letters, and official notices in their mailboxes. The Department of Education is gearing up to reactivate its powerful collection tools, including wage garnishment and tax refund offsets. For those who are behind, the consequences of unpaid student debt are about to become very real again. For borrowers in default, the quiet period is ending. The threat of aggressive collections, lost tax refunds, and damaged credit is back, and the pressure to find a solution is mounting. This transition marks a major shift, from the broad safety net of pandemic relief to a renewed focus on enforcement and repayment. The landscape for student loan borrowers is changing once again. Millions now face a new reality. The government is coming to collect, and the options for relief are far more limited than they were during the pandemic pause. The break is over, and the stakes are higher than ever. For many, the next steps will determine their financial future for years to come. The Trump administration has announced that starting January 2026, collections on defaulted federal student loans will resume. The Department of Education will begin by sending notices to about 1,000 borrowers, warning that wage garnishment is imminent. Each month, more borrowers will receive these notices as the process ramps up. This marks a return to pre-pandemic enforcement, with the government using its full authority to collect on defaulted loans. For many, the safety net is gone. Ignoring defaulted loans is no longer an option. The threat of having your paycheck reduced is now very real. Borrowers must confront their debt and make a plan. The era of leniency is ending, and the government expects repayment. The time to act is now. Wage garnishment is a legal process that allows the government to take money directly from your paycheck before you even see it. This means a portion of your earnings is withheld by your employer and sent straight to pay off a debt you owe. This often happens if you default on a federal student loan, meaning you've missed payments for an extended period and haven't made arrangements to catch up. Unlike private lenders, who must go through the courts to garnish your wages, the Department of Education has special authority. They don't need a court order. They can start the process on their own, making it much faster and harder to avoid. Here's how it works. After about 9 months of missed payments, you'll receive a formal notice at least 30 days before garnishment begins. This notice is your warning and your opportunity to take action. The notice will detail exactly how much you owe, how much will be taken from each paycheck, and what steps you can take if you want to object, request a hearing, or set up a repayment plan to avoid garnishment. If you don't respond or resolve the debt, your employer will receive a legal order requiring them to withhold a set percentage of your pay. This is not optional for your employer. They are legally obligated to comply. The withheld money is automatically sent to your loan servicer every pay period. This continues until your debt is fully paid off. or until you make new arrangements, such as entering a rehabilitation program or consolidating your loans. Your employer has no choice in the matter. They must follow the law, and there's no room for negotiation or exceptions. For many, this process feels automatic, stressful, and even embarrassing. It can be difficult to explain to your employer or coworkers, and the loss of privacy can add to the anxiety. Losing a chunk of your income each month makes it much harder to pay for essentials like rent, groceries, and transportation. It can quickly lead to financial strain and tough choices. Wage garnishment is designed to force you to address your debt, but it can have serious consequences for your financial stability and peace of mind. Understanding how it works is the first step to avoiding it. The government can garnish up to 15% of your disposable pay, not your gross income, but what's left after taxes and required deductions. For example, if your take-home pay is $800 every 2 weeks, $120 could be taken out each time. That's $240 a month, enough to make a real dent in your budget. For those already struggling, this loss can mean missing rent or skipping groceries. Garnishment continues automatically until the loan, interest, and fees are paid off, which can take years. The law protects a minimum amount. At least 30 times the federal minimum wage per week is exempt. As of late 2025, that's $217.50 weekly. If your disposable pay is below this, garnishment can't happen. But for most full-time workers, the 15% rule applies. The impact is immediate and long-lasting. It's a serious consequence for falling behind. The government's authority to garnish wages for student loans comes from decades-old laws, the Higher Education Act of 1965 and the Debt Collection Improvement Act of 1996. These laws let the Department of Education bypass the courts and collect directly from your paycheck. The pandemic pause was a rare exception, not a permanent change. Now, officials say they're legally required to resume collections. Federal student loans are different from private debt. Stronger collection tools protect taxpayer money. The return of wage garnishment is framed as a return to normal legal operations. The rules are clear, and the government is enforcing them. From the government's perspective, resuming wage garnishment is about fairness and protecting taxpayer dollars. When borrowers default, taxpayers foot the bill. Officials argue they have a duty to collect what's owed and keep the student loan program sustainable. Wage garnishment is a last resort, used only after months of missed payments and failed outreach. The Department of Education offers income-driven repayment plans and other options to help borrowers avoid default. Money recovered through garnishment goes back into the system, funding loans for future students. Enforcing repayment is seen as essential for intergenerational fairness. The pause on collections was temporary. Now the government says it must uphold the law. Borrowers signed contracts to repay. Resuming collections is about honoring those agreements. The message, repayment is not optional. Critics, including borrower advocates and some Democrats, call the return of wage garnishment harsh and counterproductive. They argue it targets the most vulnerable, low-income workers, those without degrees, and people facing long-term hardship. Taking money from small paychecks, they say, deepens poverty and instability. Lawmakers like Elizabeth Warren and Cory Booker have proposed suspending the government's collection powers. Critics want more focus on relief and affordable repayment, not punitive measures. They argue wage garnishment is inefficient and costly, often collecting little after fees. Automatic enrollment in income-driven plans, they say, would be more humane and effective. With many families still struggling post-pandemic, critics question the timing and fairness of renewed collections. They call for comprehensive reform before aggressive enforcement. If you're in default, wage garnishment means less take-home pay, up to 15% gone before you see your check. This can force tough choices, which bills to pay, which to skip. The stress can strain your mental health and family relationships. Saving for emergencies or the future becomes nearly impossible. Garnishment can last for years, keeping you stuck financially. The government can also seize your tax refund, often the biggest payment families get all year. Even Social Security benefits can be taken. The return of collections means all these tools are back in play. For many, it's a financial crisis that demands immediate attention. Understanding your options is critical. If you're facing the threat of wage garnishment, remember, you're not powerless. There are practical steps you can take right now to avoid or stop garnishment before it impacts your paycheck and your peace of mind. The first and most important thing is to act quickly if you receive a notice about garnishment. Don't ignore it or put it aside. Responding promptly gives you more options and time to resolve the situation. One of the best moves you can make is to get your loans out of default. This can open up new repayment options and stop the garnishment process before it starts. Loan rehabilitation is a powerful tool. By making 9 affordable on-time payments over 10 months, you can have the default status removed from your credit record, giving you a fresh start and restoring your eligibility for benefits like deferment or forbearance. Another option is loan consolidation. This process combines your defaulted loans into a new one, which can get you out of default faster. However, keep in mind that the default may still appear on your credit report, so weigh your options carefully. If you believe there's been a mistake, or if wage garnishment would cause you serious financial hardship, you have the right to request a hearing. This gives you a chance to challenge the garnishment and present your case. Don't hesitate to reach out to the Department of Education or your loan servicer as soon as possible. They can explain your options and help you start the process to resolve your default. Be open and honest about your financial situation. Ask questions, and don't be afraid to request help or clarification about your repayment options. There are affordable repayment plans available, including income-driven options that adjust your payments based on what you can afford. Don't wait for garnishment to begin. Explore these plans now to protect your income. Taking action today can safeguard your paycheck, reduce stress, and help you regain control over your financial future. Every step you take now makes a difference. The key is not to delay. Your financial stability and peace of mind depend on the steps you take right now. Start today, and give yourself the best chance for a brighter financial future.